Hello, and welcome to the Wade Borth podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Okay, today we're going to be talking about I can get a higher rate of return in Nelson's book, Becoming Your Own Banker. Again, we have Nicole, Tate joining us to have the discussion around this chapter. It starts on page 69 of Becoming Your Own Banker, the Infinite Banking Concept book. And this is really an interesting chapter for us today, too. And again, Nicole, thanks for joining us to discuss this chapter because there's a lot of information around this chapter. I hear it all the time. I can do better. I can do better. And I don't know what you hear when you talk to your clients or even what your thought process was when you first read this and when you first started applying this process to your life.
I think that was the very first objection that I actually heard from somebody when I said, hey, I'm looking into this infinite banking concept thing. And then the question of why in the world would you do that? Because you can put money in the market or you can put money someplace else and get a higher rate of return. So I feel like we say this with every chapter, but there's so much good stuff.
It is. And again, why does it take 20 or 30 hours of podcast to go through the entire book? Because there's a lot of nuances. There's a lot of experience that you bring, a lot of experience I'm bringing to this, and just either our own experiences or experiences that we've had and discussions we've had with our clients that have brought up a lot of interesting parts. And this is a great one. And this really goes back to the old adage of the seen and the unseen. And I think this is really an unseen part, but it's very clear once you understand it. Once that door is open, you're going to look at this and go, oh, why didn't I think of that? And
Yeah.
I just did the traditional Norwegian head slap. You can't see it on the podcast, but Nicole can see it. I was like, oh, slap my head. Like, why didn't I see this before? But this is truly an objection I get a lot. Not a lot, because people that read this understand this or they have a feel for this. They just want some clarification around. Because
he writes in here in the very first paragraph, and this just sums it up so perfectly. We are not addressing the yield of an investment. We are discussing how you finance anything that you buy. And I think you told me very early on, Wade, that savings is not investing and investing is not saving. And so you can't confuse the two. Exactly.
That's where I think people, again, are conditioned to think one way. And again, why are we conditioned to think that? Why do the banks, let's just take it back to the real simple things. Why does somebody want you to think a certain way? It's to influence your behavior. And so, again, what the big money, the Wall Street and the banks don't want you to do is understand the banking process. If you don't understand the banking process, then you have to rely on somebody that does. You have to rely on the Wells Fargo, the Bank of America, the Chases of this world. And the question is, are they small, poor companies? Do they not make money on a year-to-year basis? Or do they make very good money?
I would say they make very good money.
And this is the part I don't try to convince anybody of anything. My job is to educate people. If they get it, if they don't, good luck with what you're doing, and then they can move on. I'm not here to argue and drag you into this idea. There's no adage that this is either caught, this thing is caught, it's not taught. I'm a firm believer that a lot of people, by knowing more, would be able to catch it. It's just that it doesn't come to them naturally right away. And it's partly their fault, but it's not really their fault. It's just what's been bombarded, it goes back to your client that was getting a toaster from the bank. They spent a ton of time trying to find the right account, the right bank to put their money in. And this goes back to the previous chapter, the cost of acquisition. How much time and money did she spend to go over and get a free toaster? It wasn't a free toaster, but that was the conversation you and I have had in the past. But the point is that banks make tremendous amount of money. And if this was such an awful place to put it, if having a properly structured policy was such an awful place to put it, because quote unquote, I can do better in my investments, then why does Bank of America have $25 billion in properly structured life insurance?
Yeah, and I think we still have to go back and remind people you can't confuse these policies with an investment. We're talking about two different financial vehicles.
Right. Yeah.
With two different goals, two different reasons for being.
Right. So let's talk about this real quick, because that's a great point to be made, is that what's the purpose of a savings? What's the purpose of safe, secure, liquid, guaranteed money? Because that's really what you have in your policy, right? When you do a properly structured policy, safe, secure, guaranteed, liquid money. Yeah, when you put all those parameters on there, is it going to be the same return you're getting on your real estate investment? Is it going to be the same return you're getting in the stock market? And I'm going to say it's going to be different. It could be better. It could be worse. So I had a good friend of mine, Todd Langford, used to always say this. He says he had somebody come to him and he says he wanted to talk about the guarantees of the policy because he thought he had Todd over the barrel. And Todd says, hey, I'd love to talk about the guarantees of your policy compared to what, right? That's Daniel Pink always says, well, compared to what?
Right.
He says, well, I'm going to compare it to my investments, my mutual funds. He goes, okay, fine. He says, so here's what the insurance company, the very least amount he says, let's pick 10 years. Let's pick 20 years, whatever it is. He says, what's the amount that the insurance company, the very, very, very least the insurance company is going to make sure that's there? And they looked at the number and he says, okay, now what's the least? What's the guarantee? What guarantee can your mutual fund bring you? And the guy thought about it for a little bit. And he said maybe a 0% rate of return. He says, Todd goes, gosh, I wish it was that good. He says, only thing they can guarantee you is 100% loss of everything. That's the only thing they can guarantee you.
Yeah, it's a very interesting way of looking at it.
But again, this is the true example of comparing apples and oranges, or probably apples and elephants. They're completely different animals altogether. One is designed for you to take control of the banking function in your life. One is designed so that when you want to finance something, you have a safe, guaranteed bucket of money that you can always access. That's ran for your benefit. The other one's speculation. One has nothing to do with the other. Now, I've done this, and I've known clients that have done this, that because they had the safe, secure bucket of money, they were able to take control of the banking function in their lives, and they could go out and buy real estate when nobody else would lend them money to buy real estate. And when you think about it, banks only lend money when you don't need it. I learned this when I was growing up, and my dad always said when price of cows at that time in the late 70s, they were depressed and they were low, and there wasn't a banker that would give you a loan on those cows. But as soon as the price of those cows went up, doubled in price, then the banks were clamoring and jumping all over themselves to lend you money to buy an overinflated price of a cow or a piece of land or whatever it was. But they wouldn't give you the money. They wouldn't borrow you the money when you absolutely needed it to take advantage of an option. So one's an investment has risk and speculation. The other one is a safe, secure bucket of money, savings, that's guaranteed to be there when you need it to take advantage of an opportunity.
Yeah.
So I can do better with a higher rate of return. We can talk a lot about this chapter, and on the second half of the first page, Nelson talks about what they're saying, what the argument is that I can put my money in investment and do better. But the problem is if you put it into investment, can you get access to it?
Yeah, that's a really good question. And I guess that really depends on what investment you're putting it into and what it's doing. If you've got your money in the market right now, maybe today it's worth getting it out and maybe it's not.
Yeah. But the point is that money in your policy continues to grow and compound and do what it's going to do. If you use it as collateral or if you don't, it continues to grow and compound, no matter if you're using that feature that allows you to borrow against it, collateralizing. And again, you're the number one ranking borrower against that money. And what I mean by that is nobody else outranks you. You have the first choice, first refusal to borrow to use the insurance company's money.
He also writes in here in that second column, and we talked about this in a previous podcast. So there's 2 points that I wanted to make here. The first one is he says, there's a delay in time while getting the banking system established, but once this is done, it is a one-time only event. That kind of goes back to the cost of acquisition. But then he goes on to say, when a life insurance policy is created, and he's talking about a banking policy, that is the equivalent of starting a business that never existed before, and the same phenomenon is inevitable. It takes a little bit of time to capitalize it.
Think about that. You just started a scratch business, a business that was never there before. So it takes some time to make that happen. But then he goes on to the next paragraph, and he talks about it's kind of like a trust. And I think there's a real confusion about what people think life insurance actually is. And to boil it down to some real simple terms, a policy is just really a professionally managed bond and mortgage portfolio with some other things scattered into it. So it's professionally managed bond and mortgage portfolio ran for your benefit at an institutional level, guaranteed never to go backwards once money's there. Again, this is the definition. Yeah, this is the definition of a mutual insurance company. What is their charter? What do they have to do? What is their obligation? is to take in money, run it. They have to invest the money because they have to have know that the money is going to be there to pay obligations in the future. And like a trustee, he talks about it's like a trust. They're obligated to run it for the benefit of their policyholders and make interest on this, make return on it. But they can't be taking a lot of risk because they have to have money there available, so they don't take risk, and it's done at an institutional level with professional money managers. Where else do you get access to have people do that for your benefit? And when you want access to it, you can borrow against it. You don't have to pull it out. Your money continues to grow and compound. You can borrow against it, guaranteed, because that's in the contract. If you think about it, you don't have a guaranteed access to your home equity line of credit. Does the bank have to give you a home equity line of credit?
No.
No.
And if they do, you have to go through the process of filling out the application and getting approved and all of that stuff that we talked about previously.
Exactly. And do they give you 100% of your equity? No. If you have $100,000 in equity, what do you get? 80%, 75% loan to value?
Yep.
So you talk about, and does that ever change? That never changed. And again, in the previous chapter, the cost of acquisition, we never touched on that part of it. But everybody's, I put in X amount of dollars, I don't have access to it immediately the first year. You have 75 or 80% equity first year. That's not any different than your home equity line of credit. I don't see why people get bent out of shape out of one and not the other. But the point being is that you have access to that equity that you have in your policy, and then it's still professionally managed and still grows. And then once money's there, it's guaranteed never to go backwards. What other place can you store your money that gives you that availability?
Yeah.
And look how much, you actually should be saying, like Nelson says in this chapter, look how much money the trustee is making for me, for my benefit. That's the real key. And to keep it safe and secure and liquid. All those things they're doing for your benefit. And this is the reason why, again, I'll go back to Bank of America. $25 billion, that's billion that's why banks put a tremendous amount of money with insurance companies. Because they understand this, right? They understand that it's not about the rate of return. Do you think they care about what the rate of return is? If you understand how banks make money, right? If you go back and you listen to our podcast, when you understand how banks make money, where they pay Nicole, they're going to pay you $1 for the use of your $100 bill, and they're going to charge $6 or $5 for the use of that $100 bill to me because I'm going to be the borrower. That's where they're making money, because that's a 500% markup on that $1 they gave to you. That's where they're making their money. That's the banking function of where they're making it. They're not concerned about what we call the internal rate of return, because, again, that's where the Dave Ramsey of the world all want us to focus on, is this internal rate of return. Well, that's not the important part. The important part is what I call the external rate of return. Nelson, in his seminars, gave an example about buying some property from a guy that he knew that was short of money, that needed cash. He had access to cash, so he said, I'll give you the price he was asking for it, and turned it around in a couple of days and sold it for twice as much as what he paid for it. What's the rate of return on that?
Right.
That's the part that people miss, is that access to cash, having access to cash when you want it and when you need it to take advantage of opportunities or to take advantage of chaos, has much bigger return than the quote-unquote internal rate of return. But we've all been conditioned to think about the internal rate of return being the most important thing that's going on with these policies. And that's actually the least important thing.
Yeah, just thinking about how you put that, it's intuitively people want to have cash on hand because they know that cash can help them take advantage of opportunities. And yet we've been conditioned to think that it's better to have money invested, that you can do better with that than you can do with having cash in a life insurance policy. It is just all the conditioned thinking. As you talk, I just think through some of the conversations I've had with people and some of my own questions and thoughts as I was learning about IBC, and just how much the conditioned thinking of society, of banks, of government entities, of all of these other entities outside, how much that has impacted the way that I looked at this type of process and said, I don't understand.
Yeah. And what was the difference? What was that change that thought process? What in your mind you said, okay, I get this now?
For me, the biggest thing was the ability to have control of my own money. Yeah. And you and I have talked about this before. As you get older and you have more experiences with money, why is it that somebody, we had no credit is worse than bad credit. I was horrified. I was 30 years later or whatever that is. Still, I'm like, how did that happen? But I accepted. We ended up having to go get a loan with a cosigner. I didn't even realize at that time that didn't even help our credit. That didn't help us at all. Reading this and going, you mean I can have control of my own money? I don't need to go and ask somebody else permission. That's what really made me go, I want to understand this more.
Yeah. And that's the whole point, is that we're beholding when we don't have other options. When you only have one place to go for money, that's not an option. It's like you got one place, one store, one grocery store to go buy your stuff from. And they can put whatever rules that they want into play, and you have to follow by them if that's what you do. The next step is that if I have a different place to go and I can control that, then I can choose to use their store. I can choose to use my store. It makes sense that I use my store more often than not, but I still have that choice. And now, because of that, they have to start changing their rules. They have to start to be more efficient. They have to start to be better with their customer service, whatever it might be. They have to change what they're doing, because now you've developed, in essence, competition. And initially, competition is going to be one. It's going to be you. And as you build your system and as you have money available, you're going to find other people now will become your customers of you as well.
Yeah.
But the point is, go ahead.
No, I was just going to say, and then that goes back to but I can get a higher rate of return.
Right.
Maybe not.
Yeah,
Saving is not investing.
Right. Saving is not investing. Again, I'm in Nelson's book, The Warehouse of Wealth. This is a great example, is that, and I'm going to talk through the Borth family bank real quick to have an understanding of what I'm saying here. But if let's say I need money for a piece of real estate that we want to buy, and I go and I say, hey, I'm going to borrow the money from the insurance company. I'm not taking my own money. I'm not using, quote unquote, my money. I'm using the insurance company's money, and I'm paying them a bit of interest, because they have to put it to work and they have to be profitable, right, in order to pay me and pay everybody else that's part of the mutual insurance company. So I'm borrowing their money. And let's say I'm going to borrow it at 5%. And it's not that right now, but again, I'm a simple farm boy from North Dakota, so let's keep the math simple. 5%. Then I go and I buy my piece of real estate. I've charged the Borth Real Estate Investment Company 10% to use that dollar. And they're gladly going to pay it, because it's basically a signature loan. That's all it is. It's a guaranteed signature loan. So they don't have to put up collateral. They don't have to do anything else. So they're going to say, okay, we're going to do this at 10%. So they do that. So I've purchased my money at wholesale at 5. I'm selling it at retail at 10. What's my markup?
On a percentage basis, it's 5%.
On a percentage basis, it's 100%. I bought a hammer at 5. I'm selling it at 10.
Correct. Yes, you're right. Yes. Sorry.
No,
that's why people get confused.
Exactly. But the point is, that's 100% markup, and I have really zero friction in the process. I don't have extra overhead to pay. I don't have my time, right? My cost of acquisition, my time. So it's the 20 minutes it takes me to put the documents in my corporate bylaws, to draft the documents. I pay somebody to do that for me. So I'm borrowing the money at 5 and putting it out on the street at 10. Now, when that money comes back, I pay back the insurance company their principal plus their interest, because that's what I owe them. And I take that extra money and it's not really interest, because I put it back in my policy of additional premium. So if you think about it, we're in the business of money, of finance, right? And our inventory just happens to be cash. But where we store our inventory has got to be super safe. And so this warehouse that I'm storing in, it just happens to be my properly structured life insurance policy. And I think there's a lot of confusion behind that, but it's just that simple. I have to store it somewhere. If I embrace this banking idea of controlling the financing and the banking function of my life, and I start doing this, it's this simple. It doesn't have to be more complicated than that. When I get that extra interest, I can either leave it in my separate Borth family bank, which is just as simple as just checking account number 2 at my credit union. Or if I'm not using it, I'm also put it back in my policy so I can have safe, secure, guaranteed storage of my money. But it's just like a hardware store owner that buys a hammer at 5 and sells it at 10. They take their profit and they go buy more inventory, because that's the whole idea behind Nelson's grocery store idea. We're buying more cans of peas, as it were. Where we store that isn't in our cans of peas. It's just we're storing our money. We're storing our money in our warehouse, which just happens to be our policy, a property structure policy. And when we get past, so do I care what the rate of return is on that? I just want to make sure it doesn't go backwards, because I just made 100% markup on my money. Now, that was me in The customer and the person borrowing the money and the person lending the money are the same person, just two different businesses. But what if I borrow you the money? Now I'm getting your money at 10%. I'm paying 5%. Now I'm just taking that extra money, that interest that you're willing to pay me, willing to pay the Borth Family Bank, and I'm putting that extra inventory back into my policy. So I can go out and find 3 or 4 or 5 more people just like you that are willing to pay that 10% interest.
Yeah, and so my question early on would have been, why would I pay you 10% interest?
Why wouldn't you?
Maybe because I can't go anyplace else to get the money. So I'm going to go back to this idea that my husband and I are building this non-traditional home. And it's quite possible that if we went for financing that they would say, not going to do that. So we still, assuming that in that case we still want financing, then we have to go someplace else. We have to go a non-traditional route to say, hey, we need some money to get this home built. Who's going to do that? Maybe you would be the type of person that would say, let me evaluate that. Yes, I would be willing to do that. Here's your interest rate. At that point, I either want it or I don't.
Now I'm in control because I control the banking function. You're the person that's borrowing the money. So you either play by my rules or you go find somebody else. So I've done this with a gentleman that was flipping houses. He bought the house. He could get financing to buy the house, but he couldn't get financing to do the flip. And hard money loans at that time, still, I don't know where they're at now, they're probably moved up, are 15%. I said, hey, I'll borrow you the money. It's 15%. Why would I do less than what the market is charging?
Yeah. I've got a lady that's doing hard money loans at 20% right now.
20% right now? If we do it again, we have to look at it. I just haven't looked at it in a while. But again, if you can lend your money out at 20% and it costs you 5 to get it, think about that for a second. How valuable is that? And then when you get that extra interest in, that's just more inventory you can buy. So go ahead and shuffle that back into your policy in the form of extra premiums, right? Pay back your loan, put that extra money back in your policy because that's just your warehouse that's storing your inventory. So the question is, why would I borrow it from me? Because you're willing to pay somebody else that price. I'm not requiring you that I don't need 3 years worth of tax returns and bank statements, and I'm not requiring all that. So it goes back to the cost of acquisition. If I can say, hey, I'll borrow you that money, but I want 15% and we can get this deal done in 5 minutes or 10 minutes or an hour or whatever it takes, you might be willing to say, I'll pay you 10 versus paying the bank 8 or 7 or 9 or whatever it might be, because I don't have to go through that acquisition cost of getting my money.
Yeah.
And if they don't want to pay it, then that's perfectly fine. My life will go on. It won't change what I do. But I at least need that to make it worth my risk to put the money to work. In other words, I could just leave it in my policy. I don't have to pay that 5% interest in order to acquire the money.
Yeah.
So does that make sense?
It does make sense.
So
the title of this chapter, but I can get a higher rate of return, it goes back to can you? Maybe not. We're not even talking about the same thing.
Right. One is you're giving your money to Wall Street and with their promise that you might get something. They can't guarantee anything. The only thing they can guarantee is 100% loss. Here, you're controlling the banking function, and now, again, there's no guarantees. If I lend my money to a hard money lender, do I have headaches with that? It could end up with the property. There's a lot of different things that might go on, sure. But I'm a lot closer, right? So this goes back to the whole Austrian economics thing, is that these type of transactions, the banking function should be done at the you and me level. That's the whole idea behind Austrian economics and where Nelson came from. Is like the closer we are to the you and me level, the better off we're going to be. Eliminate all the intermediaries. And we're going to be better off. But the point is, the conditioned thinking we've been under is to have us focus on the wrong thing. It goes back to the problem. We're focusing on the wrong thing.
Yeah.
We're squabbling over the scraps when we're missing the whole meal that's on the table.
And you have to really ask the question, how did banks get so large? Yeah. It's quite simple, really, because it is a huge business and everybody needs money and everybody needs financing at some point in time, and somebody's going to provide that financing. And that's how banks got so huge, because somehow we decided that the banks were the ones that were able to do this, not the individuals. And the more that we ceded that control of the banks, the bigger they got.
Right. And all we're saying is, don't think like a consumer, think like the banks. They have us all chasing our tail, thinking like consumers, and they have us stop thinking like banks. And again, this goes back to the idea that we're also concerned about the scraps or this, we're at the water cooler and you got 8% on your investment and I got 3% or 7% or whatever it is. on a very small number. Where if we take a step back and say, what if I could control the whole banking function of my life, and I could, in essence, take control of the interest we're paying to some other organization, and now we pay it back to our organization? It has nothing to do with rate of return. It has to do with flow back of money when we put it to work. So the investment and the rate of return lies outside the policy and what you're doing when you borrow the money from the insurance company to start your business, to buy a piece of real estate, or whatever it might be. That's the external rate of return that we should be focusing on, and not worried about, quote unquote, the internal rate of return because I can do better in my investment. But you could, but you can't get access to it in order to buy a piece of real estate. When back in 2008 was a great example. There were a ton of people that thought they had money. The market crashes, their accounts get cut in half, and they have no liquidity to go buy real estate that was also cut in half or even 75%. I got examples of guys that did that. They had money in their policies, and they bought homes that were discounted 50 to 70% in Arizona. And now those prices of the homes have come back. They've got rental off of them. And what's their rate of return? It's in the thousands of percents. Can your investment do better than what? Than the life insurance? Probably than the life insurance. But having that life insurance and that guaranteed bucket of money led to a much bigger return. And that's the part that people misses.
Think that'll ever happen again, where there will be opportunities that assets will be on sale and there might be opportunities to snap them up at half price?
No, there'll never be opportunities like that. That was a once in a lifetime thing. That only comes around every 5 years. There's always opportunities. I talked to a guy yesterday, and he was making the point that he's buying properties right now still at a 20 to 50% discount. And not because they're distressed. It's just because people are tired of them, and they just want to unload them, and they don't want to go through the process of having somebody get financed and blah, blah, blah. He says, we just go in and we make them an offer. And these are the wholesale guys. They're just going and buying properties. Maybe they need work, maybe they don't. And they're offering people 70 cents on the dollar. And it's quick. It's like, if you want to do it, we can do this in 2 days. And boom, they're snatching up these properties left and right. Not because people are in desperate need. It's just that they don't want to go through the hassle. They've made a tremendous amount of money on the property, and they're willing to let it go, but they don't want to list with the realtor and then having somebody back out because they can't get financing, or they got a problem tenant, whatever it is. But he says, if you have cash and you can make an offer to somebody, he says, we're finding tremendous values. And it's like people made 100 to 200% on their houses that they bought in 08 and 09, and they're just tired. They want to get rid of it. They're willing to give up. The convenience is worth more than the price, I think is what he said. I'm like, well, that's a great point to make, is people are willing to give up a certain amount of profit for the convenience of being able to unload this thing in a day or two. And that only happens when somebody has access to cash that they don't have to get approval for. And now that rate of return, and then what they do is then they buy these things and they turn around and they sell them. They wholesale the deal, so they'll put a couple $1,000s down and then make $15,000 to $20,000 on these wholesale deals. Heck, that's a great example of your external rate of return being huge. Concern and squabbling about what the internal rate of return is on the policy. Again, if it was such an awful place to put money, like the Dave Ramsey people say, if it was just a terrible place. First off, Dave Ramsey doesn't understand properly structured life insurance. But if it truly was an awful place to put it, why do the banks put billions and billions of dollars into these things? Yeah. Do you think they're stupid? They must be stupid, Nicole, because you're telling me that you should put your money in the market and never put money in life insurance. It's a terrible place to invest.
Well, I just wrote down, don't think like a consumer, think like a bank.
Exactly. All right, there's great lessons to be learned, but don't get caught thinking about what the banks and Wall Street want you to think about. Think about, again, how do banks make money, and do I want to act like a bank? I don't want to be a bank. I want to act like a bank. I want some characteristics of a bank. And when you start thinking that way, this becomes very clear.
Very good.
Well, thank you. I appreciate the time you've taken on. There's great wisdom to read this, reread it, listen to the podcast, have a discussion, reach out to Nicole, reach out to me if you have additional questions, because there's so much here that you're not going to catch it all. You're not going to catch all the nuances. I've read the book multiple times, and I don't catch all the nuances of what he's telling us. And there's just, again, it's just a thought. Changing your thought process a little bit is going to lead to tremendous wealth in your life. It may not always be money. It might be time. It might be purpose, relationship. You get a lot of freedom when you have control of that banking function in your life.
Yeah,
Thank you again.
Wade.
I look forward to our future as we wrap up the book. I look forward to finishing this up, and hopefully people are getting value out of the content that we're putting forward in these podcasts. If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button, and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family. We can be easily found on Apple Podcasts and Spotify.